If you're anything like me, you're doing everything you possibly can at the moment to think about the new year, look at the Australian property market and decide which area to invest in. So for those of you who have earmarked Brisbane over the last 1, 2, 3, 4 or 5 years, this video is going to be very, very helpful because I'm going to talk about some of the positives and some of the negatives associated with the Brisbane and Southeast Queensland market in 2020. I'm going to talk about what you can expect, what's coming next, and what Australia's top analysts are talking about or forecasting for the coming year. Now, sorry the camera's a little bit shaky this morning. My name's Ben Everingham and I'm the director here at Pumped on Property. I'm actually on my way down to Brisbane. My brother Simon has just bought his second investment property in one of the beachside suburbs for well under 400k. So we're going down to the building and pest inspection now, which is super exciting. The reason I'm in my singlet and looking like I've just got out of bed is because I've been at Pilates this morning with one of my mates, plus the other 80-year-old women that do it with us. But let's talk about Brisbane property market. So in 2019, not too much happened up here. In fact, if you look at CoreLogic's data, Brisbane property market on average went back by about 1.9%. It actually went backwards in 2019, and that's pretty normal considering that the Sydney property markets and Melbourne markets were so disrupted in 2017, 18 and 19. But it looks like those marketplaces have kicked into gear again in terms of Sydney and Melbourne, growing by 8% since July in 2019 until the end of 2019. So with positive prices moving again down there, there seems to be more positive sentiment spreading into Brisbane. Now, there's a few crucial things that you need to understand about Brisbane. Firstly, the population is growing in Brisbane and Southeast Queensland at a faster rate in terms of Australians moving to a part of Australia than anywhere else in Australia. Now, that is important because population growth is one of the key drivers of short-term, medium-term price growth with properties. Brisbane's just gone from what was probably a pretty significant oversupply of inner city units, as you guys would be aware, to a balanced marketplace for the first time in 5 years. And that's going to have an effect on supply and demand, particularly because over the last couple of years, mainly the last 3 years, with APRA making it so hard for investors and developers to get money, not as much development stock has come onto the market. And therefore, all of the excess stock and land has been picked up. And we're in a position where a lot of the suburbs are seeing the lowest vacancy rates that I've seen in 4.5 years of buying there, and that many analysts have seen in the last 10 to 12 years. So that's exciting on top of the population growth. Another thing that's really important about Brisbane right now is wages have started to move over the last couple of years, and the average household income in Brisbane is now higher than the average household income in Melbourne, although the property prices are obviously significantly cheaper. Two more key pieces of data in terms of the bigger picture, and then I'll get a lot more granular about Brisbane in 2020, is the fact that the Brisbane property market, according to CoreLogic, is now cheaper to buy than it was in 12 years ago, 2017. That is an important factor because if you look at Sydney and Melbourne, for example, the average growth in those markets is, depending on the suburb and the type of property, has been somewhere between 50% and 100% since the last GFC, where what they're saying is Brisbane, when you take out inflation, is actually cheaper to buy now than it was 12 years ago. I just heard a video from CoreLogic where they're also saying that Perth is actually cheaper to buy now than it was 14 years ago. So obviously markets move in cycles. If you look at that, the growth in the years just leading up to the 12 years ago in Brisbane, prices moved by about 100% in the 5 years leading up to 2008. So there was massive price growth. What happened is that 10 years of price growth was created in 3 or 4 years, and therefore the market got very, very, very expensive, and it had to settle itself back down, become affordable for people. And now that it's affordable, and now that the population's moving and there's infrastructure going in again, we'll see what happens over the next second half of the cycle. Now, obviously growing up in Sydney myself, I had a very, very strong bias to Sydney, and I know a lot of people watching this will have a very strong bias to the state or the city or the local market that they live in because it's what you know, and I completely understand that. I felt the same way. But when I first came out of Sydney and started to seriously look at moving my portfolio to Brisbane, because Obviously, it was pretty clear in 2016 that we'd reached a top in Sydney and prices were going to decline in the short term. What I did is I looked at some data that was put together by Homely, and they collected that data from CoreLogic and the Australian Bureau of Statistics. And what they looked at was Sydney, Melbourne, Brisbane and Perth markets year on year in terms of property price growth or declines over the last 46 years leading up to 2016. And what they found, or what I found from analysing that data year on year, is that Brisbane has grown on average of 9.7% per annum over the last 46 years. Sydney has grown on average by 9.6%, and Melbourne has grown on average by 9.55%. So there'd be a lot of people sitting there in Sydney and Melbourne because Sydney and Melbourne have performed well in the short term, which is called recency bias. People think that just because something's done well in the short term, it'll do well in the medium to longer term or immediate future. And that's a very, very dangerous bias to have. And what I found through looking at places like Brisbane against Sydney and Melbourne was that Brisbane has performed equally or actually better than those markets in the last 50 years. And that gave me the confidence to start looking at it. Now, I've reviewed another really interesting article from CoreLogic last week. And if you don't subscribe to their newsletter, I highly recommend it. They provide some incredible data. But what they looked at was over the last 30 years, the price differences between Sydney, Melbourne, Perth, Brisbane, Canberra, Darwin, Adelaide. And what they did is they looked at the gap between prices in Sydney and Melbourne versus those other marketplaces. And at different times of the cycle, obviously prices in different areas are higher. At different times of cycles, prices in certain areas are lower. What I found is that looking at Sydney and versus Brisbane, or Melbourne versus Brisbane, there is probably the most significant gap in prices between the two markets in the last 30 years. Now, if you were to look at the chart, what happens is the gap stretches right out as Sydney and Melbourne prices go first, and then the gap closes as Brisbane market increases in value, and then the gap grows again, and it's this constant band width change. But right now, the difference between prices in Sydney and Brisbane is almost 100%, where the long-term average over the last 50 years has been more like 45 to 55%, depending on whose data you're looking at. So again, that says to me either one of two things: that Sydney is now a global city, and that like New York or like London or like Singapore, it's always going to look very, very different from Brisbane moving forward. Or prices in Brisbane and Perth are very, very subdued right now because they haven't grown in 12 to 14 years. And over the next 7 to 10 years, we can expect a little bit of upside in those particular markets, particularly as the population grows. Now, I have a theory about Sydney and Brisbane and Melbourne that is untested on data, but I just have a feeling, and that's from looking at the population statistics and the population growth rates of Sydney, Melbourne and Brisbane over the last 20 years. And what I've found is that about, once every now and then, property prices get so high in Sydney and Melbourne that it creates a mass exodus out of those two markets into other markets like Hobart, like Perth, like Brisbane, like Adelaide, and the regional markets surrounding those cities. Now, I believe that in 2016, property prices were so high in Sydney that a lot of people, and rents were so high that a lot of people had sort of given up on the Sydney dream, and we started to get a bit of an exodus out of Sydney, which is why the population growth rates in Brisbane and southeast Queensland have been so strong. But what happened is that APRA stepped in, obviously artificially pulled down the prices in the Sydney market and stopped that speculation, and obviously created a 15% decline in Sydney and a 12% decline in Melbourne between, late 2016 and mid 2019. And what that did is it made people in Sydney and Melbourne living there feel like prices are more affordable again. Because prices have come down by 15%, it gave people living in Sydney and Melbourne a little glimmer of hope. And in some markets, particularly Sydney and Melbourne, where there was an oversupply of units, it's also had an effect on rents, which made rents a little bit more affordable, and rents declined by about 15 to 20% in those two markets in a lot of suburbs as well. Now, that gave people a glimmer of hope, and a lot of people who were thinking about exiting out of there, whether they were baby boomers people finally cashing in on their super, because super in Australia finally got to the point where the share market was the same value as it was before the GFC in 2019. And, instead of moving out, people went, well, it's affordable, prices are declining, maybe we can afford to get in. Now, what's happened between July 2019 and December 2019 is that prices in Sydney and Melbourne have recovered in a crazy way. I've had clients that have literally made $600,000 in the last 5 months on their properties, that bought at the very bottom and that have obviously got good price growth. The average price growth in Sydney and Melbourne has been about 8% over the last 5 months, which is, again, what I think is going to happen between now and the end of 2021 is prices are going to get back to their 2016 levels in Sydney and above their 2016 levels in Melbourne. People are going to feel overwhelmed. There's going to be pressure on mortgages. There's going to be pressure on people who want to buy or want to downsize, that don't want a huge amount of debt on their loans. And I think for the first time since about 2006 or 2005, there's going to be another mass migration north to Brisbane, to the Sunshine Coast and the Southeast Queensland Gold Coast. And that's going to create massive pressure on this market, because there is not enough stock for all of those people to move into, which is going to place pressure on prices. Now, this is untested. This is like a crazy Ben theory, but looking at the population data, looking at sentiment, and looking at where Sydney and Melbourne are going according to SQM research, which is about 15% higher than it was in 2000, or at the very bottom. So effectively, the market's not actually moved. The market's just going to recover to where it was, or maybe a little bit better than that, because people are a bit silly sometimes. And then we're going to see a mass migration north. Now, this is just what I see coming. If you look at the analysts in terms of 2020, 2021 in Brisbane, SQM research sort of said that if the Liberal government got back in, which they did, and that if the Reserve Bank of Australia dropped rates 2 times, which they have, they expected somewhere between about 8 and 13 to 15% growth in Brisbane between 2019 and 2021. Core Logic is saying that they expect Brisbane to increase on average by about 1.9% in 2020. And then certain parts of Brisbane are expected to grow by between 4 and 7% in 2021. So it depends what type of investor you are. I personally like to buy at the bottom of a 12-year low before it starts to grow again, or a 13 or a 14-year low, depending on how long this lasts. I don't like to be the person that's buying, in 7 or 8 years' time when the market has moved by 10%, 50%, or whatever's going to happen in Brisbane over that period of time. So, that's interesting. HTW puts Brisbane at the the start of the recovery stage of the market, or the bottom of the market right now, which is a great stage. Again, that's a really nice monthly moving index that you can keep an eye on in 2020. But yeah, I think with population growth, with the infrastructure going in, I did another blog, which is over on my website, www.pumpedonproperty, where I looked at the infrastructure going into Southeast Queensland, and I saw $48 billion worth of projects already approved on the Sunshine Coast, Gold Coast, and in Brisbane. This is shovel-ready projects that have already got the green light to go ahead over the next 7 years. So there's massive amounts of work up here in infrastructure and construction. Obviously, tourism is going okay at the moment. The downside of 2020 and 2021 is they are the sort of dates that Phil Anderson and Fred Harrison have been saying for the last 5 or 6 years are kind of the mid-cycle slowdown point. So as you can probably see, if you start to look around in Sydney, Melbourne, Brisbane, Perth, the Sunshine Coast, Wollongong, wherever you are, there's a lot of commercial offices for lease at the moment. There's a lot of empty retail space at the moment as well. And if you start to look around, you'll notice what I'm saying. Confidence in the business community isn't strong because we're not sure what's happening with the trade stuff in China. We're not sure what's going on in Hong Kong. Obviously, the euro doesn't look great right now. All of the Brexit stuff's coming through now. All of the America stuff coming through. You can see that all of the all of the reserve banks around the world and all of the Fed banks around the world are dropping interest rates at the moment. You can see that money around the world has been harder to access over the last year and a half as well, slowing things down in the infrastructure area. You can see that it's slowing things down in the residential and commercial construction area. You can see that not as many businesses are taking loans, that more businesses are going into foreclosure at the moment. What Fred Harrison and Phil Anderson and Ray Dalio and Warren Buffett are all saying at the moment is that we could probably expect a stock market correction at some point in the next 2 years, maybe in Australia. They're saying definitely in America, but they've been saying that for a while now. You can also see that a lot of the governments around the world are very, very heavily indebted, which again means that one of the levers that they normally pull when we get into a market condition like this, there's a great book by Red Dalio called Big Debt Crises. He says when we get into these tricky economic environments globally or nationally, there's levers that governments can pull to get themselves out of it. One is making it easier to access money. 2 is reducing interest rates. You can see that they're doing that at the moment. It's much easier to access money in Australia right now than it has been at any point in the last 4 years. They're giving much better rates to people as well. The principal and interest rates have normalised again in Australia. Another thing that Ray Dalio says they can do is the government can start spending money on private and public works and infrastructure projects, which the Australian government's committed to an 8% increase in infrastructure spending in 2020 and a 15% increase in infrastructure spending in 2021, which is, if you know this stuff and you understand the cycle, just perfect timing to create more jobs, more high-paying jobs, similar to what they did in the GFC with the solar. Another thing that governments can do, according to Ray Dalio, is to tax businesses and tax higher income earners. The beautiful thing about Australia is they're actually reducing the tax rates at the moment, or that's the Liberal government's plan for high-earning individuals and businesses, which means more money can flow into the economy. Businesses can put on more staff, or businesses can be more profitable, therefore buying more stuff. And the last thing that Ray Dalio, and he's the most successful investor of all time, his company Bridgewater Associates has been the top performing hedge fund in the world for the last 30 years straight. He's got the highest average annual performance over that time. He's got some great videos on YouTube and some great books as well. Principles and Big Debt Cycles is another one, or Big Debt Crises. The last thing they can do, and you saw Kevin Rudd do this in Australia with the baby bonus back in the GFC, as well as the helicopter money that they call it helicopter money. The government's just done it as well with people's tax returns. For those of you earning under a certain bracket, you would have got that refund of between $500 and $2,000 extra in your latest tax return as well. So, that's another thing they can do. And you can see governments in Australia and all around the world are literally pulling all of these levers right now to try and make things smoother. Now, the difference between this mid-cycle slowdown and the big picture slowdown, which is like a GFC or the Great Depression or the recession we had to have in the 90s, is there's still massive amounts of money sitting on the sidelines right now. There's people like you that have savings in the bank. There's huge amounts of the hedge funds have gone into cash positions. The banks have, a lot of the banks around the world have improved their balance sheets over the last few years. You can see that a lot of the big companies around the world, like Apple and Amazon, have massive cash reserves sitting there. A lot of professional investors, whether they're property investors, developers, or share traders, have massive amounts of cash sitting on the sidelines at the moment waiting for the correction, which a lot of people took advantage of in Sydney and Melbourne in the last couple of years. But there's a lot of cash on the sidelines, I suppose, is what I'm trying to say. And because interest rates aren't at zero, there's a lot of things that governments around the world can do, reducing interest rates, dropping helicopter money, spending more money on infrastructure. You can see Trump is doing a shitload of that in America right now, and will do more of it in 2020 with an election year coming up. He's going to spend massive amounts of money to create more jobs, to make everything look good for his election. But I suppose the difference between this mid-cycle is there's still cash sitting on the sidelines. People still aren't all in. There's a lot of self-managed super funds with a lot of money sitting there as well. Where at the top, the banks are all in, the governments are all in, the private investors are all in, the personal investors are all in, the professional investors are all in, the hedge funds are all in, and therefore when the crash comes, a lot of people get burnt because they don't understand that it's coming, and they can't remember the last major crash because it's been a while since we went through one. So again, I don't know if you're interested in that stuff, but I am. The more you learn, as Zig Ziglar used to say, the more you can earn. So it's important to understand this stuff. If you're interested in the big picture cycle stuff, check out Phil Anderson's work. His book, The Secret Life of Real Estate and Banking, is amazing. I did a podcast with him recently on the Pumped On Property show. Check it out on Apple or Spotify or the other channels. There's a great book by Phil Dalio on this stuff called Big Debt Crises, which you can understand the last 100 years of these cycles and different events around the world and the worst events in different countries, so that you can understand the way that things happened. You can also look at Fred Harrison's work. He's incredible. He predicted the 1990s recession in his book, The Power in the Land, in 1983. He published that, telling everyone what was going to happen. He also published a book in 2005 called, what was it called? Boom and Bust, which called the 2007 GFC. Again, imagine if you had that information, between 7 to 10 years in advance, and what you could do with that, understanding these cycles. Check out what Warren Buffett's saying about this stuff at the moment. He's very, very public about his position, and he's giving great advice now that he's at that stage of his life. But yeah, so Brisbane looks interesting from a lot of perspectives for me. What I particularly like is you can buy really high quality property close to the city. There's some suburbs in Brisbane right now between 10 and 12 kilometres from the city as the crow flies. And you can buy good quality houses for between $500,000 and $600,000 there. And then if you go literally 1 to 3 kilometres closer to the city, there's absolutely no difference between the suburbs. In fact, some of the suburbs further from the city, all they are is further, but they've got much better numbers of owner-occupiers. They've got much higher incomes. They're much more family-friendly areas. And some of these suburbs, for example, 7Ks from the city, there's houses selling for $1.3 to $1.8 million right now, where the suburb 10 to 12Ks from the city is selling for 500 to 600K. Like, there's just this crazy disconnect in Brisbane right now, and that's the same in the beaches. There's some beachside suburbs in Brisbane where you spend $1 million to buy a property 17Ks from the city, and then there's another beachside suburb 24Ks from the city where you can literally buy a home for 400 or 500K. And that was like the good old days in Melbourne and Sydney 20 years ago. Now all of the beachside suburbs in Sydney and Melbourne are worth a fortune. All of the suburbs in the good parts of the city within 15Ks of Melbourne and Sydney are worth an absolute fortune. There's not this crazy disconnect or this, honestly $1 million difference between one area and another with a few kilometres in between. So I love parts of Brisbane. I really like North Brisbane. I really like East Brisbane. I really like the CBD. For those of you out there who are seriously looking at this market in 2020, 2021, please book a strategy session in with me over at www.pumpedonproperty.com. Myself or my brother Simon will sit down with you. We'll look at where you are right now. We'll look at where you would like to be in the future. We'd like to talk about your plans for the next year. And then we might be able to talk about how you could become one of the small number of clients that we take on in 2020 and help enter the marketplace with confidence, knowing that, as your buyer's agent, we can help you create a plan for entering the marketplace up here. We can help you create a plan that gets you great capital growth, long-term and cash flow. We can help you create a plan to make short-term equity and take advantage of the marketplace based on these disconnects of unrenovated to renovated places, or existing homes to brand new, or 7Ks in the city versus 10. There's just so many opportunities in Brisbane for smart people over the next 7 years. I want to educate you on all of those things, and then I want to help you become a better investor and invest in this marketplace with confidence, Our business has bought over $250 million worth of property in Brisbane in the last 4.5 years now. We really specialise in very particular parts, very close to the city and right on the beach. Can't wait to continue that conversation with you. I wish you all the best in 2020. Stay safe. As always, be aware, be cautious. And if you haven't already done so, please give this video, this podcast, a thumbs up. If you're listening to this on the Pumped on Property Show podcast, please give us a 5-star review. If you're listening to this on YouTube, please subscribe to the channel and please share this with someone who needs to hear it, because there's only a limited window now in Brisbane over the next couple of years where you can actually buy at the bottom. We'll still be buying this market for the next 5 to 7 years, but if you really want to buy well, now is the time, now that things are looking a little bit better for different parts of Australia. And once we get through this little mid-cycle slowdown point, you'll be able to start to see what I start to see. You just don't want to be rushing in when everyone else starts getting up here. So I wish you all the best. Give us a thumbs up. Have a great day. Have a great year. And kick some ass. Go out there and achieve your goals. Cheers.